Holy smokes everyone, catch me outside, how about that? In today's video, we're going to be going over what's happening in the markets. We're going to be going over what's happening with the Fed. We're going to be going over the market crash and why the Federal Reserve is powerless to stop what is going on right now. Okay, so first things first, what are we seeing in the stock market? Well, today, as of recording this, we saw the Dow fall about another 1.5%. We saw the S&P fall about 1%, and the Nasdaq fall around another 1.3% as well. So what this is telling me is this sell-off, people, like I've been warning about, is only just begun. It is just getting worse, and we haven't seen the worst of it yet. What we have also seen is a flight to safety with bonds and with gold, which I'll get into later in the video, about how you can protect yourself during this market crash that is going to be coming. We've also seen risk on assets like Bitcoin, cryptocurrency, they've been falling as well. So what you're wanting to know is, okay, well, we've already seen, a pretty big sell-off. The Nasdaq is down now about 16%. Many stocks are already down over 50%. Most stocks in the S&P 500 is already in a bear market, like I've been talking about. It's only a few of the large cap tech stocks that are lifting the index and holding the index up. And once they really start to plummet, that's when we'll see the major indexes really start to plummet. But again, like I've been saying, this stock market crash, it has already been going on for a while. Most stocks have hit, and it's just a matter of time before those large caps start to fall as well. But what I'm going to talk about today is why this time is very different. I know it's dangerous to say this, these words in the markets, but it is very different. And really every time is different in some way. So we need to talk about the Federal Reserve rate hike cycle, which I've been covering extensively on the channel. I've been saying, inflation isn't transitory for, the past 8-9 months now, when everyone was talking about deflation. I've been saying the Federal Reserve is late to the party. Now they're going to have to lift interest rates more. In December they're saying, yeah, okay, inflation's not transitory, but don't worry, we'll only do 3 rate hikes. But now then the market started to price in 4 rate hikes, then 5 rate hikes, then 6 rate hikes. Now you have banks like JP Morgan saying there's going to be 9 rate hikes in a row. So again, people, don't believe what the media says, what the talking heads on CNBC say, what the Fed says. You always have to look at the macroeconomic picture, look at reality, look what consumers are doing, and make up your own decision. Because many of these talking heads on CNBC, especially Jim Cramer, which will tell you to go in all in one day and tell you to sell everything the next day, definitely can't listen to them. But what has normally happened during previous rate hike cycles was, in the stock market, there's something called the price to earnings ratio. And during other times, like in the 80s and the 90s and the early 2000s, besides the dot-com bubble, the PE ratio was around 15 to 18 when the Federal Reserve started lifting rates. And you've had many people say, well, don't worry, because in other rate hike cycles, where the Fed has lifted interest rates, stocks have continued to go up. Well, what's happening this time is the Federal Reserve is going to start a rate hike cycle when the price to earnings ratio is at 25 times. So this time is very different, people. They've made this bubble so big, they've lifted asset prices so high, they've kicked the can down the road for the past 40 years, and they thought they could get away with this without any consequences. When now we're about to pay the consequences for delaying the inevitable. And like many people say, if you don't deal with the bubble, if you make the bubble bigger, keep on ignoring it, well then things are just going to get worse, and it's just going to make the crash worse. So that is the first point I want to make in this video with the issue with the Fed, that valuations are much higher this time, and that means this crash is going to be worse than other rate hike cycles. Now, what we also have this time was, what you have to know is this is a big scam what the Federal Reserve is doing right now. They're saying, okay, inflation's out of control, so to deal with 7.5% official CPI inflation, we all know the real inflation figures is 15%, and it's really the heights we've seen since 1940s, we'll lift interest rates to 1.52%. When people, what they did the last rate hike cycle in 2018 is they lifted interest rates to 2% because that's just what they normally do once the economy gets out of recession. That's just normaling monetary policy. So them saying we're going to fight inflation by lifting interest rates to 2% is a complete lie. By them saying we're going to stop QE, we're going to sell off our balance sheet because of inflation, it is a lie, everyone. They were going to do that anyways, regardless of inflation being high or not. That is just part of normalizing monetary policy. So in order for them to fight inflation, what they're not going to tell you, but what eventually will happen is they're going to have to lift interest rates much higher. Now, the debt is much higher now, the bubble is much bigger, so maybe they're not going to have to lift interest rates up to 15%, you know, like they did in the 80s. Maybe it'll only take lifting interest rates up to 5% because, again, the debt is so much higher and the valuations are so much higher to pop the bubble. But like I said, even lifting interest rates up to 5% will have catastrophic effects on the markets. So this brings me to my next point. Normally the Federal Reserve has always been there to save the day when the markets have crashed over the past 20 to 30 years, because they've had the luxury of so-called low inflation, when we all know, even though there's been low inflation, a low CPI read over the past 30 years, the cost of living for the middle class has been skyrocketing much more than 2 or 3%. So they're not going to be able to reverse course on this one. Now also what we have happening is the Russia-Ukraine conflict. And what is this causing right now, everyone? This is causing the price of oil to absolutely skyrocket. I think Brent crude oil hit $98 today. And with Russia being one of the biggest suppliers of oil and gas in Europe, this is going to cause the price of gas and oil to continue to skyrocket higher. Many people are saying it could hit $120 a barrel. And what high oil prices causes is a weakening economy. It has a large input cost for consumers. Consumers are already feeling pain at the pump with high gas prices. Companies are going to have to pay more for higher gas prices and fuel costs. And so this is going to really hit the economy, and it's going to make inflation worse. We've been seeing a big part of the CPI has been surging energy costs. Energy costs have gone up 40-50%. You know, even transportation costs, used car prices and trucks have been skyrocketing 40 or 50% year over year. And unfortunately, I think a reason for that is because people have to live in their cars now because they can't afford these rents. So the sad reality of why used cars and trucks are going up so much is we're seeing a housing boom, but not a kind of housing boom you would think, and not a kind of housing boom you want. We're seeing consumers having to live in their cars because what average, you know, American can afford $2,500 to $3,500 rent a month. So that's the next big risk. People are thinking inflation, you know, is going to get better, and it's going to come down. The Federal Reserve is not going to have to lift interest rates up. But if this conflict between Russia and Ukraine gets worse, and oil continues to skyrocket, well then that means, you know, if oil goes to $120, $130 a barrel, we could see 10% CPI. And even me, I'm noticing when I go to the gas station now, gas, what we call in Australia here, petrol prices, we pay per litre, are the highest I've ever seen. I've seen some places hit $2 a litre. Where I'm in regional Victoria, it's a bit cheaper, around $1.80, but I have seen some places hit $2 Australian a litre. So again, that's just another reason why the Federal Reserve is not going to be able to save the markets. And what this could lead to, and what I think investors aren't really prepared for, is this could lead to a lost decade, where, you know, most people say buy the dip, it'll recover next year, it'll recover within 3 years, 5 years. Like I've shown you in previous videos, since the Great Depression in 1929, the markets didn't recover for nearly 30 years. Again, in around 1968, the markets didn't recover till 1993. So what I think is going to happen, or what is the risk, is maybe the markets don't recover for a decade, or even worse, maybe it doesn't recover for another 25 years like the Great Depression and like in the late 60s and 70s. And that's something I don't think investors are prepared for at all. But I think something we have to acknowledge could be a real possibility, because like I said, once this crash happens, the Federal Reserve is not going to be able to save it because of surging inflation. And we've been kicking the can down the road to try to stimulate the economy. We haven't been more productive. We haven't become more efficient. They're just throwing money at the problem, hope things will, you know, get better. So then, okay, what can we do when we know, you know, the markets are in big trouble? What I've been, you know, telling people, and what I've been doing is I've been dollar cost averaging into gold, because when you look at inflation adjusted chart, gold actually hit a peak in 1980, inflation adjusted, of $2,400 an ounce. You can look up that chart there. I'll try to find it and put it up on the screen. So what that tells me is gold still has a lot of upside to at least $2,500 an ounce. Now I know many people have been saying, look, gold hasn't done anything for the past 10 years. Well, that's exactly why I want to start dollar cost averaging into gold. I want to be in assets which have been depressed for years and years, which everyone thinks is dead, which will give me the most upside. You don't want to be investing into assets when they're at all-time highs and FOMOing in. So I think gold has a lot of potential, especially if we do enter a global conflict. People normally flock to safe havens like gold, and that's what we're seeing right now. And that also gives me a hedge instead of staying in cash and waiting for the crash. Again, I still am building cash on the sidelines because I think I'm going to be able to get some stocks and some cryptocurrencies on some good discounts in the future. But that also gives me a hedge in case inflation gets worse and my cash in the bank gets devalued. And we're also seeing people flock in the 10-year US Treasury because that's also known as a safe haven asset. But me personally, I'm not a fan of investing in bonds. So everyone, that was just a quick walk and talk. That was just some of my thoughts on what's going on in the markets right now. Some things we definitely have to consider, what I'm doing to play these markets. But this is an open debate. What do you think? Let me know. Now, for all my loyal viewers and subscribers still watching, you're awesome. If you're interested and want to get up to 5 free stocks when the market does crash, you can use my link in the description with Moomoo for when you deposit $100. Thanks for watching. I'll see you in the next video.